Welcome back everyone. So this is a new video and this video will be about AI economy and why investors are spooking because they are comparing this AI bubble with dot-com era bubble, and what are my thoughts into that and what exactly I am doing. I will be discussing that, as well as I will be also sharing why I am out of my silver positions, which has given me quite a lot of profit in small amount of time, and I will be sharing my thoughts into that. So let's get started. So here's you can see the chart and basically the bubble economy. Somebody has tweeted it, and what it's showing basically is OpenAI and Nvidia is kind of the central players in this whole circular economy, which investors are comparing this with dot-com bubble era. So if you don't know what happened in dot-com bubble era was there were a lot many startup companies, and those companies were actually not having real users, and each company was basically customers to the other company and similarly likewise, and basically they were showing they have actually real customers, and those real customers were basically the other companies, but those companies were actually not having legit end users like the retail users for any kind of use case. So dot-com bubble era was kind of the tech was there because obviously internet helped us a lot, but the timing was not right. But in AI economy still there is a bubble. As you can see, there is a huge bubble creating up, and there's some kind of speculation going on because recently what happened, Nvidia kind of invested a lot of money into OpenAI, and then OpenAI committed to invest some amount of money into Nvidia. So what's happening is, even though Nvidia is kind of investing the amount into Oracle, but it's coming back as revenue to Nvidia, and that's kind of bloating up the figures. But what I feel is there is some truth to it, this is actually not good for long term. But on the other hand, why it's not dot-com bubble, what at least I think, because there is legit use case for end users, and there are a lot of end users who are basically using AI to boost their productivity, and even I am using a lot nowadays AI. In fact, all these videos and these things, I take immense help of AI into doing those kind of things. So I see there is a practical use case for AI, and it will definitely help people. But the only thing is these companies are not yet making cash, or they are not yet making profit. So what's going to happen, that's something obviously as an investor we should be thoughtful about. But what recently OpenAI has stated, they are going to turn profitable in next 2-3 years, so we need to wait and watch. And also one more thing I would like to show is you can see the blue line is basically the internet dot-com bubble era, and AI boom is the currently. And you can see in the dot-com bubble era there was a crazy run up, but this run up has not yet happened in AI bubble, I mean current times. And one more thing which is very interesting is during the dot-com bubble era, the prices to earning ratio of the companies were 130, and you know who was the star of that dot-com bubble era? That was Cisco as a company, and Cisco company was having a prices to earning of 130. And currently the star of the AI boom is Nvidia, and Nvidia is having a PE of price earning of around 32, which is quite a less compared to dot-com bubble era. So I think even though AI is signaling a lot of doom scenario, because particularly for the circular economy, but I think there's a lot of room to grow, and let's see how it works out. Also, I'm going to basically play a video by Jeff Bezos recently where he appeared for interview, and he was telling about the AI bubble, right? And this is one of the reason why I'm investing more in Google stock, because it's one of the most cheapest valuation AI company available. Apart from that, there are some other companies also in AI which I'm investing, which I'm going to show in later videos as we cover progressively. But one thing about this interview about Jeff Bezos is why AI is going to be a very important part of life, and why we should not fear the AI bubble, right? So let's hear what he tells, and I will share my thoughts on this.
Back in time, in the year 2000, when the internet bubble burst, Amazon's stock in a very short period of time went from $113 a share to $6 a share. And by the way, it's split many times since then. I don't know, 20 for one or maybe even more. I don't have the number. But so these prices have nothing to do with today's stock prices. But to go from 113 to 6 in a short period of time was very concerning. And shareholders were upset, employees were nervous. We had all of our employee base, their parents were all calling our employees and saying, "Are you okay?" This was the environment of great nervousness. But I looked at the numbers in the business. And every month, as the stock price went from 113 to 6, a number of customers went up every month. Our gross profits went up every month. Our operating expense, we were still in a loss position, but our losses as a percentage of sales went down every month. Every single business metric, new customers, customer repeat purchases, everything that we were monitoring through that entire period kept getting better. And so that's one observation about bubbles in general. The fundamentals can be disconnected, the fundamentals of the business. And of course, as entrepreneurs, you're focused on the fundamentals of the business. The stock price is an output, an ultimate output that you actually have very little control over. Benjamin Graham, the great investor, is famous for saying, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And so as founders and entrepreneurs and business people, our job is to build a heavy company. We want to build a company that when it is weighed, it is a very heavy company. We do not want to focus on the stock price. And so that will be misleading because it can be disconnected from the fundamentals. And when bubbles happen, so that's one thing that happens. The second thing that happens when people get very excited, as they are today about artificial intelligence, for example, is every experiment gets funded. Every company gets funded. The good ideas and the bad ideas. And investors have a hard time in the middle of this excitement distinguishing between the good ideas and the bad ideas. And so that's also probably happening today. But it doesn't mean that anything that's happening isn't real. Like, AI is real, and it is going to change every industry. In fact, it's a very unusual technology in that regard, in that it's a horizontal enabling layer. Today we talk about AI first companies like OpenAI and Anthropic and Mistral and so on and so on and so on. There are so many startup companies that are kind of AI companies of various kinds. And that's normal for this phase. But that is not the biggest impact that AI is going to have. The biggest impact that AI is going to have is it is going to affect every company in the world. It is going to make their quality go up and their productivity go up. By every company, I literally mean every company, every manufacturing company, every hotel, every, consumer products company, et cetera, et cetera, et cetera. And so that is hard to fathom, but it's real. There is no doubt. We don't know how long it will take exactly. We don't know how quickly that transition will occur. And it will probably occur at different rates in different industries. But that is very real. Now, what the stock market does, which is when we think of bubbles, we think of valuations and market caps and things like this, and how many billions of dollars are being invested in these 6 people at a $20 billion valuation, even though they just started yesterday, right? That's very unusual behavior. Investors don't usually give a team of 6 people a couple of $1 billion with no product. It's rare, and that's happening today. But the great thing about industrial bubbles, this is a kind of industrial bubble, as opposed to financial bubbles, and I'll tell you what I mean by that. If you go back, like the 90s had a biotech bubble, and there were a bunch of pharma startup companies that were designing drugs and using new techniques, and the world got very excited, the investment world got very excited. As a group, they all lost money, but we did get a couple of life-saving drugs. A bubble like a banking bubble, the crisis in the banking system, that's just bad. That's like 2008. And so those bubbles society wants to avoid. The ones that are industrial are not nearly as bad. It could even be good, because when the dust settles and you see who are the winners, society benefits from those inventions. They still get those life-saving drugs. And that's what's going to happen here too. This is real. The benefits to society from AI are going to be gigantic.
So, in nutshell, what Jeff Bezos was trying to say, obviously there are risks associated with current AI circular economy, but there will be a lot of companies who will be absolutely shattered, right? But most of the companies will be shattered, unfortunately. There will be few companies who will be emerging as the new global AI superpower, or the companies, right? And among these companies, I think one of the companies will be Google. Of course, there will be Amazon and Microsoft, and even a little bit of Nvidia, could be Tesla also. But I am betting on Amazon, Google, and Microsoft, all these three. And currently, I am investing heavily on Amazon and Google because the valuations are extremely low compared to other AI companies. And I will show in later videos also like why I feel so in more detail. But that is why I am investing in Google more and more. And this is the chart which shows exactly what's happening for AI boom and internet boom charts. So currently I am showing one of my portfolio where basically I have investment done for Google stocks. As you can see, like I have a XIRR of 30%, and this XIRR is in dollar terms. In INR terms, I think it should be around 33 to 34% XIRR. And one thing is like I have like multiple portfolio I am managing for my family members. So basically I have around XIRR of 25-30% in US portfolio as well. And as the videos go on, I will be sharing more on the portfolio performance as well as my decisions about basically what I'm buying or selling, right? And as you can see, like I have invested around $10,000. And the funny thing is I just invested like 2 days back before this recent. But yeah, I cannot time the market. I thought like I have to buy more and more Google. And you can see like I'm in kind of a 20% profit overall, but my XIRR is 30%. And if you can see in the next window which I'm going to show, is like I have actually purchased a lot of shares. And you can see I have purchased share on March 5th, and that is during the time when the tariff drama was happening. And you know what, I made a huge profit in this $6,000 when I invested. I have actually made a returns of 60% for this amount, but the XIRR was showing 30% because I just purchased on 9th of October, again $5,000. And if you see the Google performance, Google has gone up by around 60% year to date from the time when I bought. But still I'm buying because I think Google has a lot of room to grow. I think it will give 17% CAGR returns in dollar terms. In INR terms, it should give 20%. And I am aiming my portfolio, if I can get 20% sure short returns, I'm good, I'm happy enough, right? So I'm not being extra greedy. I think this company is definitely a buy. And that's my decision. I'm not encouraging any of you to buy because I'm not a SEBI registered investor. You have to do your own due diligence. These videos are all about what's my viewpoint, what I do, and just an investment journal which I want to keep for myself as well as the viewers. So here's the screen what I'm showing for Google. And I think this is a very amazing kind of tweet which kind of shows like Google is actually the Berkshire of tech. And I think Google is basically a ETF, tech ETF fund. And I mean, come on, I mean, Google has basically credit rating higher than US government, right? I think Google has credit rating of AAA plus, which is the highest possible credit rating. And that means essentially, right, this is the most trusted entity, be it government or company in the world. I mean, it's not only Google, I think there are some other big tech companies, but Google is so amazing in terms of risk that there is absolute, I mean, one of the best companies to own. And the funny thing is like it owns 14% Anthropic. And if you know, like Anthropic is basically Amazon's AI engine, Claudia and stuff. And it also in SpaceX, which is, I mean, you cannot invest in SpaceX because it's a private market. There are some ways You can invest in SpaceX also. I can show that in future. I mean Google owns 8% SpaceX, which is crazy, right? And also it has pretty good acquisition history. It has YouTube, it has Android, it has DeepMind. All these things are acquired, so it's a very good. I mean, if you say like Google is very good at identifying good businesses and buying them at good price, so it's one of the best company. I mean, I think Google is basically a tech ETF, a index fund, because it has your money into so many vertical of tech businesses. The risk kind of gets distributed and it's kind of super safe. Obviously investment, you cannot mitigate the risk to zero. There will be risk, and this is your call, like how much risk you're going to take for how much reward. For me, my 20% CAGR returns, I think I'm happy enough to take that risk, because I don't need this money immediately. I can wait for 5 years, and in fact I am just looking this portfolio in terms of 5 year or 10 years perspective. I think that's the best kind of timeline which suits my investment style and my own personal goals. So here's basically the Google stock performance, and as of today, after Trump's tariff, it's down by around 2% or so. So you can see the P ratio is around 25, and if you can see the revenue growth quarterly is 96 billion, and yearly change is 13% growth, and the earnings per share growth is around 22%. And what essentially earnings per share means is like what's the total earnings being done for a company divided by the number of shares, right? So you are buying the stock in $237 price, and each share is basically giving an earning of $2.31, right? So we are basically giving 100x price, and that is justified, right? Because it's per quarter, and every year suppose it will become around $10 or so. And if you basically consider for 10 years, then it will be like $100, right? And obviously you are paying $200 today, and that is justified because the earnings per share itself is also growing by 22%. And in investing, basically these two metrics are, I mean, pretty much very relevant in any kind of analysis. One is how much the revenue is growing, that is the top line, or the sales, how much this company is able to grow its sales, and another is like how much is the earnings per share, right? So for Google, it's around 13% revenue growth and 22% earnings per share growth, and that is commanding over 25 prices to earning ratio, right? And this basically means what's the current price divided by the earning per share, right? And if you see for same kind of company, that is like Amazon, for Amazon you can see the basically the P ratio is around 33, right? And you can see the revenue growth is around 13%, same like Google, and but the earnings per share growth is quite a lot, that is 33%. I mean, come on, I mean the size of this company is like around $2 trillion market cap, if I'm not wrong, and in that market cap, growing earnings per share by 33% is, it needs a huge moat. And that's why I'm heavily invested in Amazon and Google both. I'm going to share my Amazon portfolio also in the next video, so stay tuned. Comment out below if you would like to engage more in these videos for the US stocks or for Indian investment or my investment journey. It will be really a valuable feedback for me, so that I can share more of my the videos with you guys. So coming back to again similar kind of company, that is Microsoft is trading for 37 PE, right? And again, these three companies are all the hyperscalers, cloud growth, and this kind of all I mean these are basically the big tech companies, obviously. So these are kind of same kind of companies. And if you see the revenue growth of Microsoft is 18%, it's the highest out of all the three, and the earnings per share is 23%, right? So if you kind of balance for all these three companies, you can see the earning per share growth is actually for Google it's around 22% and revenue is 13%. For Amazon, earning per share is 33%, 13% revenue growth, and for Microsoft is 23%, 18%. So yeah, Microsoft, Amazon is trading for around 35, 37 PE, right? 33 and 37 P. But Google is trading for 25p. I think it should expand to 30p, the kind of company Google is, and compared to the other peers like Amazon and Microsoft, as I showed. So 30p is like, I think should be happening, might be in 5 years, might be 1 year. I don't know. I don't time the market. It's just more of a like, I know I should be able to get 20% CAGR in INR terms, and in dollar terms, it should be 17% CAGR. So coming back to our Indian market, I want to share some update on my portfolio. And that update is like I have been recently sold some silver bees. And the reason is like because as you can see from the table here, it's like I have been actually buying a lot of silver bees, which is from the Nippon AMC. And this is basically commanding premium of 9% over the physical bullion silver. Essentially what it means, like this ETF, the silver ETF, whatever you basically buy, the AMC essentially has to buy equivalent amount of a real silver, physical silver bullion, right, in their asset, so that to back the actual value of their ETF. But because of the recent retail frenzy rush, what has happened was like these AMCs are not able to source the actual physical silver, and that's why the real silver value what this AMC has and the actual demand of this ETF through retail actually has kind of diverted, and these silver bees and these kind of ETF in Indian market are commanding premium over the physical silver. And that is not good for any kind of market because it's basically breaking the link of the actual asset underneath for which the price basically reflects in the ETF. And as you can see, like almost all of the ETF are commanding a premium of 14%, 9%, 18%. Can you believe it's too much? I think only exception is Zerodha silver case minus 7%, -7%. I'm not sure why, but I was invested in silver bees. So this is one of my portfolio from where I was investing silver bees, and you can see like from September 25 to October 25. I mean, last 1 month, basically, I got this gains. Obviously, I got this silver bees around like 1 year back, if I'm not wrong. And essentially, I have lot many silver bees, which I'll be telling you shortly. But in this account, I basically got a gain of around 70% on silver bees in about 1 year, which is actually quite a lot. And actually it defeats, I mean, it kind of beats my XIRR, right, which is my target of around 20-25%. It beats it easily. And yeah, so these are kind of basically the principles. And right now I have sold this silver bee. I mean, this is basically realized profit, and because as I told, the real asset silver price and the ETF are getting diversified, so I didn't feel comfortable, that's why I sold it. And with this fund, might be I'm going to hold it for a while little bit, and might be I again jump on silver if it goes lower. So as you can see, like this is my portfolio of silver bees where I have invested 20 lakh for last 1.5 years across my 3 Zerodha portfolios, one of which I showed. And I will be also sharing the Zerodha verified PNL link for one of the account. I will be not sharing the other two accounts. I mean, slowly, gradually, I will be sharing as time progresses. And in this 20 lakh, I have basically sold around 5 lakh recently, one of which I already showed in the previous screen. And the other one is basically from the other account, which I'll be showing you later videos. And but I'm still holding 15 lakh, right? I have not completely sold out everything because I believe in diversification. So because silver has gone a little bit more hyped up recently, that's why I'm selling this. But overall, my XIRR for all the silver bees position is around 47%, which is, I think, kind of again is a great for a short term, like around 1.5 year kind of investment. So that's about it for this video, and for the next video I'm going to share more about my US stock and more about my company analysis, like what I do. So please comment down below you would like me to do analysis on Indian companies, US companies, or share my portfolio or my investment journey, right? So please comment down and do let me know. And that's it for this video. So every one of you, thank you for sticking to the end of this video. It means a lot to me. So please comment down, subscribe, like the video, and share it. Appreciate everyone. Thank you so much.